evening, ladies and gentlemen. Shall we get this show on the road? Let's make sure phones are muted. We're good to go. What's rolling on the markets? Not a lot. We've got Tim Cook taking the stage in a few minutes' time. And myself and Tim talking to you. Apple iPhone, where we're now? 17. Who knows what's going to be released? It's more of the same old thing, but I just keep buying it like a fool. Hopefully something will be a little more interesting this time. Let's see what has to occur there. We've got CPI later on this week. We've got inflation figures. We've got stuff. Maybe it'll kick a little bit of a lighter on this market, like the fuse. It's been a bit of a holding pattern, hasn't it? But we'll see. This is how the markets go. They trend, they backfill, they consolidate, they adjust, they calm down. Volatility contraction, volatility expansion. It is how it is. Let me just double check I had the right audio on. It's been a while. I missed you guys. It's been a while. So today we're going to talk about the edge from failed chart patterns. Before we get started, this month we've got an interesting theme. Let me just remind myself on this little Google Doc I've got here, planning what I've got for you, the treats I've got for you for this month. So chart pattern decoded is the chart patterns, should I say, not singular, plural. Chart patterns decoded is the theme for this month. And you might be like, oh God, what's this title all about? But the idea here is that I want to share with you stuff that's perhaps, as always, I kind of look at markets through a different lens than maybe the textbook does. And you probably do too. If you've been trading for any period of time, you know that actually looking at it slightly differently to others really gets you the results that others don't get, which is generally better results. And so this week, we're going to talk about the edge from failed chart patterns. Next week, I'm going to talk about what I call the support and resistance advantage. I'm just reading it from there, by the way, which remind myself. And that's really how to draw lines that matter. So very often we have these multiple lines on our chart, and then when the market gets to it, we don't know whether to do business there or not. So going to kind of go into that a little bit more depth. Institutional zones, what we think our institutions are watching versus just made up levels that we're watching, and how to structure ideas from there. Then candlesticks for the modern market, candlestick patterns for the modern market. So what are the classical patterns that sort of stood the test of time? What really doesn't work so much anymore, in my belief, and what's still robust and what still can you maybe integrate into your playbooks? The trap traders playbooks. We're going to talk today about a lot of sort of failed patterns, and one of them, let's be honest, will be the trap trader pattern. But we're going to go deep dive into that on the 30th of September. Then we're going to do one more week on the 1st of October, talking about how to bring this together and create the trade setup framework. So one of the things I noticed with many developing traders is how do you turn like a raw idea into an actionable setup? That's not always an easy movement to make. And should you turn it into a setup, where's the risk for that? So I've got a lot of stuff to cover this month. Thank you for joining me. I hope you'll enjoy this one. Looking forward to this week, the Summer Stoic series last month, which was good. I know a lot of you on holiday. Hope you enjoyed your summer. We had quite a nice summer in the UK, right? It was nice. I don't feel shortchanged. I feel like it was decent. So time to knuckle down though. We've got September, really get our minds into gear for Q4 as we go into Q4. And September's kind of just getting the wheels spinning, getting momentum so you can build it for Q4, get some rubber to the road, start to apply some of the things that you know you should apply, start to dial things in that you know should be dialed in, so that you have progress and some decent results for 2026. And I know that people are like, oh, why are you thinking so far ahead? I always knew that sitting, at a New Year's Eve and thinking, oh gosh, maybe this is my year, maybe this time I'll get it right, was always demoralizing. It was so much better to get momentum at the end of the year and build on that, whether you were doing well and you wanted to kind of push the throttle down, or whether you weren't doing so well, you wanted to kind of steady the ship. It was always made a better year after that if you did that. So I'm always thinking that's in my mind. But today, I'm getting ahead of myself. Today, I was talking about the edge from chart patterns. Especially to introduce myself. Some of you may not know me. My name is Mark Holstead. I have been a trader for 24 years. Yeah, 24, not quite 25 years. So traded through a lot of different market environments, a lot of different conditions, different instruments. Probably should have specialized earlier than I did, but hey, that's the journey we're all on. And I kind of share with you ideas that have helped me along my journey, but also not just that. I don't claim to be a know-it-all by any stretch of the imagination, but I do also have exposure to other traders, great traders, struggling traders, various different traders from all walks of life. And what I tend to do is I'm quite good at picking out bits that I see works for that personality type, that trader, this, that, the other, and then sharing that stuff with you, whether that's technicals that we're going to cover today, whether it's mindset stuff that we covered last month that we'll probably cover in depth at some point again in the future. I just try to blend it all together and present it to you. And like I said, I don't say that this is what you should do and how you should trade, but this is more, hey, these are ideas that I think are the best of the bunch. I'm going to filter out the ideas and the cream, if you like, give it to you, and you pick out the bits that you like and run with it and develop your own trading. So that's the way I look at stuff. Hopefully you'll find this useful today. Before we get going, I want to share with you, I like reading a little extract of this book. And some of you have been here before and like, oh, he's wheeling out his 100-year-old book again. Yes, I am. I think when you buy a 100-year-old book, a genuine 100-year-old book that was printed in 1924, so 101 years to be precise, you get the privilege to be able to wheel it out and share something from it. And today I want to read you a little extract from this 100-year-old book. And I need to be careful with this. This is in very, very good condition. I'm not going to be thumbing through it with a greasy thumb. So let me give you an extract here. By the way, this book is, show what the book is. It's Studies in Tape Reading by Richard Wyckoff. It's an original of this old thing. You can this new edition you can get from Amazon for a couple of quid. So it's that, but this is the original, not a first edition. The first edition is 1919. If anyone finds one of those, let me know. I'm a sucker for buying stuff like this. Anyway, mental poise is an indispensable factor in tape reading. The mind should be absolutely free to concentrate upon the work. There should be no feeling that certain things are to be accomplished within a given time, no fear, anxiety, or greed. And then he goes on to say, some of the obstacles which are likely to be encountered. Number one may be trading too often. Many opportunities for profit develop from each day's movement. Only the very choicest should be acted upon. There should be no haste. The market will be there tomorrow in case today's opportunities do not meet requirements. In other words, there's always going to be opportunity. We don't need to rush stuff. Wyckoff said this 100 years ago. I think it's still pretty apt now. One more for you. Anxiety to make a record, to avoid losses, to secure a certain profit for the day or period will greatly warp the judgment and lead to a low percentage of profits. Tape reading is a good deal like laying eggs. If a hen is not left to pick up the necessary food and retire in peace to her nest, she will not produce properly. If she is worried by dogs and small boys, or tries to lay 7 eggs out of material for 6, the net proceeds may be an omelette. The tape reader's profits should develop naturally. He should buy or sell because it is the thing to do, not because he wants to make a profit or fears to make a loss. There's others, but I'll leave you with those. Very apt back then, very apt today. And by the way, tape reading has changed in definition. I still believe it's reading how price responds. And today we're going to cover a lot of that. So it's not market depth, but that's one element of tape reading. You can go down that rabbit hole of a very short-term market depth, time and sales, iceberg orders, etc. But true tape reading is understanding how the market responds to certain things, whether it is a breakout, whether it is news, whether it is ignition bar, whatever. We're going to cover that today because I believe this is a big edge. It's one of those things that I think that you can focus on, and there's a lot of potential mileage in it. So let's get started. If you want to ask your questions, by the way, if you're new here, talk for about 40 minutes or so. Stick them in the Q&A. I'll get to those at the end. Okay, where are we? I'm getting rusty. I'm not even on the right screen. Let's go. Okay, edge from failed chart patterns. Great quote here from Linda Raschke. Sometimes a failed signal can have an even greater forecasting value than the original signal. I agree. I love failed chart patterns. Love. I think they're excellent. I'll tell you why in a moment. I'll try not to get too excited by these, but I think these are something to focus on. Man, it's so nice because let's not get ahead of myself. I'll tell you why I think they're nice in a minute. First of all, I need to remind you that if you're trading with a leveraged instrument, spread bet, CFD, whatever it might be, understand the complexity of the instrument, understand that the leverage is a double-edged sword when things are working well, great. Low margin requirement, woohoo. You're long, market's going up, things are very nice. But there's a flip side to that. Things can get nasty quickly and you can lose money very quickly. So please, if you're new, of. If you're not new, just understand how spread bets or CFDs work. Whatever your trade instrument you're trading works. It doesn't have to be those two things, but specifically those. And understand it's risky. It's not for everyone. You know, there's inherent big risk when trading. We try as much as we can as traders to lower that risk with things like stop losses, lower position sizing, understanding gap risk, slippage, all that hidden risk, but we can't eliminate it completely. So you have to be comfortable with taking risk. There's big potential there, of course, but there's also big downside. And we try to kind of find that fine line, but just recognize that this is not a free lunch. There's big risk when it comes to trading. So I want to make that clear. Anyone who's new to trading should go and try it on a demo, should be very, very mindful of how they're trading or what they're trading, and understand the risks involved. So that being said, we're all big boys and girls here. Let's move on. What are failed patterns? So let's define a failed pattern. So for me, a failed pattern is something that doesn't do what it's supposed to do, doesn't follow through as expected. So let's just kind of rewind maybe to the beginning. A breakout would be a traditional pattern, right? You've got a level market kind of. I've got some more charts for you. I won't be just making signs in the air all throughout this. Don't worry. But a breakout would be breaking through a level. That's a breakout. Head and shoulders. We all know head and shoulders. We get the shoulder, we get the head, which is the bigger rally, then we get the lower high, and then a reversal through the so-called neckline classical pattern, bull flag, consolidation, breakout, bear flag, cup and handle, stuff, right? A pattern that doesn't kind of, that would be a pattern. So a failed pattern is something that doesn't follow through as expected. So examples here I've got is a false breakout. It's a breakout that doesn't hold, reverses. That's the easy one. A failed VWAP hold, so volume weighted average price. Done massive loads of content on that. One of my favorite. I'd say it's an indicator. It technically is, but it's it's derived a little bit more from. All right, it's an indicator. All right, it's an indicator. VWAP, I like it. Failed VWAP hold, an opening drive, that's kind of a setup that fizzles. We'll talk about all this type of stuff. And really, this is what I want you to think about throughout the next few minutes or so, 30 minutes or so, is it's not just a pattern. I don't want traders to think that you're just trading patterns. Yes, this is chart patterns. Yes, it's chart patterns failing, blah, 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 fine, but it's people. And I want you to always think that whenever we're kind of talking about the stuff in the next few minutes, I want you to kind of look at it through the lens of this is other participants. The candles represent the auction process of other participants agreeing on a price. Now, okay, fine. If you're trading a CFD or trading a spread bet, you're not trading directly on the exchange. It's a price that's derived from the exchange product. However, the futures, they're trading. The stocks are trading. These exchange-driven products is an agreement between two parties. Say it's a CFD or spread bet product is, you're just agreeing it, with your broker, right? But you get the idea. So it's an auction process, and I want you to think and look at it through the lens of, hey, do you know what? This is people. So when we kind of look at some of these patterns and when we break them down and we see what's happened, what could happen, what's, how stuff unfolds, think of it about human beings. And yes, the counter argument, I can hear you all saying it, but Mark, there's loads of algos running stuff. I don't disagree, and you're absolutely factually correct. However, they're programmed by humans. And whilst they're getting smarter and smarter and smarter, they all have exactly the same goal: to make money. To make money, right? That's all they're trying to do. And when things go against them, they will try to reduce the loss. So they're just quicker versions of a human to a certain extent. I know I'm generalizing, and some guys are like, oh my God, I can't believe you said that. But you get the idea. There's all the kind of the same attitude to things. Okay, so why do I think these are worth watching? This is the important part. This is the thing where I think you'll go, I see now why we're talking about this. Best one to me is that stops can be structured behind failure points. So what do I mean by this? I mean that, very often, picture this, right? You see a trade, market rips off, you think that's a good drive. I want to get on board. Market pulls back. You think, yeah, I'm waiting for the pullback, maybe timing it with a moving average, whatever it might be. And you kind of go, well, where do I buy this, right? Do I buy it at the moving average? Do I buy it under? You could say I wait for it to go under and come back up, or does it do another leg? Sometimes it's not quite so easy to frame the stop. Sometimes it makes sense. The thesis is very clear, and the stop goes at a place where the thesis is kind of wrong or negated, if you like, or incorrect. When you're trading a failed pattern, the stop can be put in a more obvious level, because as the pattern unfolds and then fails, the stop goes behind those failure points. There's no thinking. And so one of the reasons why I like failed patterns is, if you say a failed breakout, which is the sort of the level one, if you like, we'll talk about more than that in a moment, but a failed breakout will go, it reverses. Where you put your stop, well, obviously you're going to put it above the failed breakout level. Bull flag that kind of breaks out. Again, all this stuff, you're going to put it at a point where the failure has occurred and there's less thinking. And I don't know about you, but the less cognitive load that I have during the trading day, the better. If all I have to do is think about, okay, when am I entering this? I know my position size. I know if I know how to structure the trade, I'm a much better trader. And I bet you are too. The fewer decisions you have to make in the heat of the moment, the better. So stops can be structured behind failure points. Two, I think like all ducks are lining up in the moment of reversal. You are getting a glimpse into the true response of price. A breakout, if it's a genuine breakout, I'm using this as a simple example, a breakout should bring in more buyers, right? If it breaks out to the high side, that breakout, by the nature of it, should attract more inventory coming in, or request of inventory, more demand for inventory coming in. Hey, I want to buy, and then you get the breakout follow through. When you don't, when price pokes its head above a breakout level, everybody sees the level. It's an interesting level that kind of comes into next week when we talk about what levels are valid and what are kind of subjective. When everyone sees that, and still the advertisement of prices, hey, we're at new highs, fresh highs, who wants it? We're going higher. And the answer is, I don't want that thing. Not for me. And the people who have inventory go, I want to dump it. That's a tell. And so when I said ducks lining up, is at that moment in time, you get an X-ray look at who's in control. New fresh highs, new got high, guys, off we go. We're going now. Who's on board? Who wants to buy more? And everyone's like, not really, man. I don't really want to pay that for it. And then look at the next man, the next man, the next man. Again, we're thinking in terms of psychology here and participants, not just patterns on a screen. They help us decipher it, of course, but we're there looking at participants and everyone looking around going, ah, man, and then you just think about if you're in the pits, right? But if that same thing happened if you're in a trading pit years ago, you're long, it rips through highs, you're like, goody, here we go, off we go, got some sides here, it's going to rally, and then it all goes quiet and it just sits there. What's the first thing that comes into your mind? Probably a swear word, which probably shouldn't do here. Pepperstone won't be too happy if I swear on the webinar, but that's the first thing. So what will you do? You start to offload some of your inventory. Like, this looks like it's stalling, I'm going to offload some, sell some contracts. But you're not the only person thinking that. Everyone else who's long is probably thinking that too. And the vultures, the shorts, are thinking, this smells like it's not going to go anywhere. Let's sell some. So you can see how that small insight, that instant in time, can really give us a kind of overview of perhaps who's in control, or more importantly, who's not in control. And very often, also why I like these, is that could be the start of a bigger move. This is not a scalp play. Well, sure, if you want to frame it as that, you can. I'm not saying you shouldn't do, but very often, if it's a failure pattern, it's going to play out over hours, maybe days, depending on the time frame you're looking at. But these are things that have a structured stop. You get it's one of the very few points you get a clear insight as to who's in control at a point in time, the inflection point, and it can mark a start of a bigger move. So I think they're worth studying. And the psychology behind it, you've got trap traders. So just like we said there, and won't go over it too much, you've got people who are in and they're like, hang on a second, it's reversing, I need to get out. So you've got the trap trader psychology, unexpected response, the market's not doing what it should do, so you get confusion. Right? Everyone says the breakout is going to go, we're going to hit this level, there's a key level here, we're going to fill the gap, whatever it might be, right? Then all of a sudden everyone's scratching their heads and they go, oh, what do I do? What do I do? I don't want to trade. A good example is if a news failure pattern, or what I call an unexpected response. Jason Shapiro calls it a news failure. Good news sells off. Everyone's like, what the? That's good news. Market should go higher. So people who are long are now confused and selling. People who are short are happy and pressing it. And people who are objectively looking at it go, hey, it feels like opportunity. So you got the combination of the trap traders, unexpected response, not doing what it should do, and the confusion creating this kind of perfect storm. So the taper failure, if price doesn't do X, the price action is telling you something. Just like we said before, if there's no follow through, Buyers are not as strong as expected. And as traders, we want to always be looking for clues, right? We're looking for the supply demand imbalance. It's a constant auction process. There's a constant seesaw. Americans call it, what do they call it? What do they call it? Teeter-totter, I think they call it. You know, as Brits call it a seesaw, right? And you're in the park, and it's a kids thing, and you've got two kids sitting on there. Boom, you know, one's a heavier, larger kid, should we say? And you know, but the price is moving one direction. So pressure of buyers, pressure of sellers, could be pressure, equal pressure of both. Everyone's doing a million shares a second at a level, it's not going anywhere. But if there's more pressure on the buyer side than the sell side, and our job as traders is to kind of judge that pivot, if you like. It's a supply demand imbalance. Sometimes imbalance, a rally, massive demand, pauses, the bull flag sitting there, and then back again into demand. If it kind of comes back into supply, something's not quite right, because the overall regime should indicate something different. So our job is not to second guess failure, right? Because I mean, I think it seems obvious that it doesn't fail until it fails. If that makes sense, right? You can anticipate it by all means, and that's a key trait of a good trader, is to anticipate and say, if this fails, I want it, or if this fails, I'm gonna kind of at least arm the trigger. It might be not necessarily going to pull the trigger, but I want to look a bit closer. That's more interesting to me. And so very often you might see, you know, a pattern, a classical chart pattern setting up, and I've got some examples I think in the next slide. And you might say, I should buy this because the bull flag is this now, and you don't want to, something's telling you not to do it, then you can always flip the switch and go, you know what, I'll trade a failure of it. I won't buy this bull flag, I won't buy this pullback. But actually, if this fails based on the regime and the context, that feels like a better trade. And so we're not guessing it, but by all means be prepared for it. Very often on trend, I'll give you one here, very often on trend days, unless I'm on the trend with an opening range breakout, or there's been some sort of pause or flag early on, you know, I don't like buying these massive trends. Different in a downtrend, because I feel there's a lot more panic coming into the bell. So often you get this kind of 8:45 UK time, or sorry, 8:15 reversal to about 8:45, and then it rolls over. You've got 15 minutes of panic selling. That's slightly different. On a grinding uptrend, personally, if I'm not on it, I'm just not buying highs. The volatility is crushed as well. It's up massively. So I won't, you know, look to chase that. But what I will do is I will note down, I'll say to myself, hey, do you know what? If this reverses, and it hardly ever, right, 5% of the time does this. If it reverses, I definitely want to be on that, and I'm prepared to allocate more risk capital to that. Here's my line in the sand. I think that will really upset people, because there'll be a lot of trap traders, and that's maybe more a trap trader strategy. But the failure is anticipated, but I'm not guessing. I'm not selling into highs assuming it's going to fail. I'm not selling into every breakout assuming it's going to fail. I'm not doing the opposite of you know, what the crowd is doing just because I think I'm smarter. You know, it's not going to work. So, you know, think about the context you're in, your levels. Where's the VWAP? What's the open been doing if you're a day trader? Wicks, not subjective levels. All become clear in a moment, and then structuring the trade around the kind of clear and validation point. So let's look at the basic one first, right? A failed breakout, a failed breakdown. Look at the theory. So obvious one is get the break, it triggers stops, crowds pile in, people buy it, triggers your short stops in the case of upside, doesn't follow through, reverses, hang on a second, something's going on. So how would we trade that if we were trading failures? Now, why I'm pausing is I want to just make it clear that nothing is certain, right? Just because it fails doesn't mean it can't then continue. We have breakouts that break out, come back, and then go again. That's the nature of the beast, which is why risk management is so important. So all these different examples will show you in a moment. You know, the important thing is, and why I like them, is you can frame it so easily and say, well, there's an obvious place for a stop. And, you know, with a breakout, it's that lack of follow through. So, for example, Dow on the day, I think this was after NFP, you know, we had that real rip. It broke through the prior days. Well, you had the response. It was like an early morning sell-off. NFP came in, open came in, bang, we rallied, open continued that drive. We took out the prior day's high. We took out the overnight high. Everyone's all aboard. All of a sudden, it reversed. And the actual reversal was way stronger because the rejection of everyone thinking, hey, this was great, this is good, but everyone's off to the moon again, we're going to be cutting rates, everyone's going to be rich and happy. Oh no, we're not. And then the reversal was often more interesting than the actual move. Another one here on a higher time frame, this daily chart, we had this kind of flat line, price just couldn't get above it, and very often, we see this and we see it looking like it's a textbook double top, triple top, rolling over, and actually it looked pretty weak at this point in time. It had broken through that prior low. We'd have the triple top. Everyone's thinking it's a perfect short. But actually what happened as we broke through the low, that was the catalyst. Price went lower. It looked around. Everyone said, I'm not selling here. This feels like a deal. And rather than the classical pattern of the failure triple top and breaking down through the lows that everyone was looking at, saying the worst case scenarios happen, we're going to roll back over here now, we're all doomed. Actually, it was the point where that pattern failed. And then within a few days, we were back up to high. It took a while to kind of get chugging, but ultimately we kind of normal service resumed. And if you were sucked into that, you were kind of shorting into the hole. And it was a kind of bit of a Wyckoff spring type trade. And Wyckoff talked about this a lot. It's the same guy who wrote this, actually. Talked about this a lot. The failure patterns are often quite good, and the spring is one of those where you have that consolidation, market pops below, everyone thinks it's breaking out, and then it pops back up. It's the simplest of the bunch, but it's one that's very easy. And you can see why you like this, because, and you know what, the thing is, traders aren't patient enough to wait for these. But I think if you were, and you had the patience to sit on your hands and only trade failures, or consider having a separate bucket, a playbook for failures, and monitoring the performance of that, I think you'd be pleasantly surprised. Because where's the stop on this? Well, it's going to be under that low. Where's the trigger entry? Well, it's probably as it breaks out through the high. And yeah, it's reasonably wide, but if you're swinging this, you've got multiple RVR on that. It makes sense. And so, often these failures are, they're clean. They're a clean way to trade. They don't happen, don't happen all the time, but when they do, I think they're powerful. Okay, so next one, let's go a little bit more advanced. Let's kick it up a notch here. Failed VWAP hold. So VWAP, the quick kind of refresher. By the way, I cover VWAP, I cover tick index, I cover more intermediate advanced stuff. If you kind of want to kind of dig down, I kind of explain it from basics first, but if you're interested in that, go to my website, tradersmastermind.com. Loads of resources on there, loads of the previous webinars that we've got. When we get them, they're put up on there, so you can look at those and you can search for any of the stuff you don't quite understand or you want to dig into. I feel like I give a good overview of how to interpret some of this stuff. So failed VWAP hold, volume weighted average price comes back down. Everyone's buying that VWAP. Good drive, comes back, VWAP's going to hold, and I like it as well. I like a VWAP buy as much as the next man, right? But very often when it fails, that's the bigger and better trade. And why? It's an institutional reference point. No need to go into details, but algos are programmed around VWAP. If you beat the VWAP as an algo during the trading day, you get a bit of pat on the back from the customer and you get more flow. So it's useful. Again, dig into more stuff if you're brand new to the VWAP, and this might sound a bit confusing. It's like a moving average if you haven't heard of it before. If you have, you know what I'm talking about here. And really, it's like, again, anywhere on the chart where you can get an insight as to who is in control, that is gold dust. That is gold dust. And something, Wyckoff here, talking about reading tape, whether you're trading on a higher time frame or 1 minute, I don't care. You're just reading how price is responding. There's only certain times you get these really big clues, and they're often around the failure points. Sure, sometimes you get momentum ignition in the middle of nowhere. That's a big clue. Separate topic. Talked about that before. No doubt we will again. But other times is when something should happen. The crowd expects the price to do X, and it does Y. Because that really gives you a massive tell as to who's in control. And like I say, is it foolproof? No, it's not. But the beauty of the failure is that you can manage the risk and frame the trade behind the failure point. So VWAP, great intraday tell for reversals. Here's the chart. This wasn't even that long ago, I don't think. I used this is the SPY ETF. So this is pretty much for all intents and purposes the S&P 500, but I wanted to to do this to show you the gap. I could have used the regular trading hours button on TradingView, but anyway, it is what it is. S&P 500 for all intents and purposes. Gap lower, rallying. Everyone's like, bull market rally, off we go. We're going to fill the gap. Off it goes, drives higher, stagnates a bit, rolls back over to the VWAP, which is the white line there. Most people are buying. You can see a little bit of a pause because the expectation is we push back up. We probably take out highs again. Everyone's happy. Now, at this point, this was where we got an insight as to who was in control. Now, was it immediate rejection? It took a while, and we had to rotate and test again. But all of a sudden, in that short period of time, 15 minutes or so, we had a true insight as to who was in control. Now, of course, we don't know if that side is going to continue to be in control for the foreseeable, but we have to make some assumptions in trading, right? It's a game of risk. If there's any certainty to it, there wouldn't be a game at all, right? If there's certainty, there's nothing for us to trade. The uncertainty is what gives us the edge. And so at that point in time, we could say, hang on a second, this is a really strong open. Maybe the gap buyers aren't that excited by this. There's a lot of traders who bought that. Institutions aren't exactly piling in at the VWAP as you'd expect on a strong trend day. If this was an aggressive day and we were maybe up above highs, you'd often see that VWAP hold. Even if it wasn't a big rip off it, you'd want it to hold. The fact that it kind of melted through, came back up, at that point, the failure's on. And you say, well, where am I going to put my stop? Well, behind the failure point. Okay, that was actually the bigger move. Okay, fine. You wouldn't call it the first chunk off the highs. Different strategy. But that VWAP area, you're like, hang on a second. And then when it starts picking up momentum through the low, through the opening print, you're like, okay, here we go. Ultimately, it wound back up. But, you know, there's a big chunk of meat of move there from the failure before we went into another another sequence. Market trades in sequences, right? You get the rallies, consolidations, you get the sell-offs, you get the congestions, you get the volatility contractions, expansions. A lot of those happen during the trading day, you know, and our job as a trader is to try to really align with those sequences. So let's talk about like a failed opening drive, right? So this is maybe a little less classical, but something I know a lot of you guys trade. I like opening drives too. If I'm trading, you know, an active market like NASDAQ or Dow or DAX for a long period of time, but that sort of thing, right? Then, you know, often that opening drive, poof, off we go. Everyone's on the open, little pauses. The expectation is going to continue, heavy, aggressive. And then you get this kind of combination of emotion, liquidity, a lack of liquidity. People are chasing. And if it works, it's great and fine. Most of them will carry on. They'll drive high. In a bull market, markets tend to drift higher. May not be that kind of a real aggressive move that carries on forever, but you kind of get that continuation. When you get an opening drive that fails, I've covered this before and I'll cover it again. This is an opportunity. I believe it's an opportunity. You make your own decisions on trading. I'm not here to tell another man or woman how to trade, but just think. Everyone's piled in. Everyone's like, here we go. We're going to have a massive rally today. I'm in. I'm margined up, leveraged up. Oh, this is nice. And you know, because we've all been on the wrong side of these trades. And then it starts to stall like don't worry, bro. It's going to keep going, man. And then it starts to roll back. It starts to roll back. And what are you doing? You're now thinking, oh, I'm going to get out of this thing. You plus everyone else who's stuck in it, plus the shorts who are pressing this. And so the opening drive is, again, a good place because that's where a lot of institutional money is flowing. And it really gives you an insight into who's in control. And as I said before, perfect way to cap the risk because you know where your thesis is and where it's not. The other day, this was a classical example on, this was the Russell, and this is IWM. Forget about what the numbers are, just the pattern matters. And forget about the market. Could be Russell, could be NASDAQ, could be FTSE. It's irrelevant. This was the Russell, and there's not many Russell traders around, but you get the idea. There are loads of examples in NASDAQ. This is the nearest one, and I don't like cherry picking too much. I want the nearest, most recent, valid example of the current regime. Gap up, rally, opening drive, off we go, big, huge opening drive. It was a massive move, right? That's like 400 points in the Dow equivalent on the Russell by 8.84%. And it rolled, and it held, VWAP held, everyone's happy, and it rolled, and it rolled, and it rolled back under that open, and it just melted, absolutely melted like an just off top of my head, snowball in an oven. You get the idea, right? It just It just and so the point is, if you weren't on the drive, and why this helps for your psychology is if you didn't anticipate the drive, you weren't on the drive, or you don't want to buy up, or it's not something, that's fine. But now what you can do is you can say, yeah, but the reversal or the rejection of the pattern would be if we traded back through the opening print, because that drive's heavy, that drive's strong. If we gave all that back, there's a damn sight lot of people trapped, and which are going to add fuel to the fire, and the kind of rejection of the actual move. So you know what, maybe I'm not going to buy this pullback. Maybe this helps you go, well, actually, if we start to push back through that low print, or the opening print, which happens to be the low here as well, I'm interested, because I think that that's really opening up some serious momentum. And even for you scalpers out there, you can grab a chunk, just grab the whole thing. But of course, you know, it's easier to frame the trade. Okay, so failed wicks and tails. So you know what a wick is, we know what a tail is. It's a candle that has that tail, wick. And something Linda Raschke says is, she called it eating the tail. So when you get a candle, a chart example in a moment, obviously, it's normally it's seen as a signal that there's a reversal. And you know, a lot of times it is, right? If it dips through and rips back up, fine. This is often the case, but we're going kind of an extra step here. It's almost inception, right? You get the failure of the pattern, and often you get a tail in there, and fine, that can hold. But then if you go one more step and that fails, very often everyone is thinking that's the wick, that's the failure, that's the exhaustion candle, and then it rolls over again. You've got an insight here that the opposite side is really in control. There might not have been in that day or that time period. Now, again, I wouldn't go too low on this, because you want volume, and if you're on a 1 minute, 3 minute, 5 even, there's not enough volume. So you want 15, yeah, lowest 50, 60, 15, 60 plus. And why I like this again is because it's very simple to frame the trade. So I drew this one for you because I couldn't find a decent example recently. I could have had to go back and find stuff, and that's the way it is sometimes, right? I'm not going to here to say to you these happen every day. They don't. But so you forgive my illustration. The left-hand side, a steady market, green candles. You get that kind of tail forming, which is it tested below the prior day's low, rejected it, off we go. Now, that in itself is a failure to reverse, but it's and everyone saw that chart on the left-hand side. Most of you be like, I love that. I'll take that long, and I put a stop under the wick low. And I would too in the right conditions. That's a nice trade, right? And you expect to continue as one little flurry lower. Now, if the next subsequent days, Linda says, eat the tail, you know, the next day it kind of went down, it started to really chomp into that what's supposedly a rejection zone, probably low liquidity. You kind of market profile volume delta guys would have seen it as, you know, very, very light prints there as it probably came through and rallied back up. If it's now starting to do business in that, that's a failure. So what do? We could consider the short. Consider the short on the failure, stop up the high. This is giving us a good insight into who's in control. The buyers were in control, and there's probably still a lot of buying, but actually they've looked around and gone, you know what? Maybe that's enough. Maybe that spooked them. And so again, a failure pattern is something that you can take and you can run with and go, how can I frame the trade? What means a failure? And as I said at the beginning, what's the lens that you're looking at things through? And imagine the participants. What are participants thinking here? Well, everyone looks at that and sees bullish. No one is looking at that and saying it's a bearish pattern. Okay, good. So it means if it does start to fail, there's scratching of heads, there's people who will be trapped, and it also is showing that that side, supply side offering inventory out, is much more in control than demand side, because it's going against the grain. And that there is like popping the bonnet, look at the engine going, okay, I see you now. You get that glimpse. Does it always work? No, it doesn't. But again, the beauty of this is you can frame it and put the stop in somewhere decent. Okay, so a quick word on news failures, right? So this is something that I call them unexpected response. And it's something I've been doing for many, many years. I always really enjoyed this. But Jason Shapiro came along and he came up with much better wording for this for me, news failure. Because what basically this is price should respond in a certain way to good news. and certain ways of bad news. Should go up on good news, should go down on bad news, right? That's kind of what should happen. Now, very often when the market does the opposite, or initially does the kind of expected move and fails, that's often very, very good opportunity. Now, some people are trading on a higher time frame, that's fine. But if you're more of an active trader, you're perhaps trading this intraday or over a couple of day period, this can be a really good trade playbook for you to study. You know, we had the other day, we had the bullish response, NFP rallied and then just failed and rolled over. And that wasn't the cleanest and clearest one, but that's telling you something. It's like everyone was piled in, you got the result you want, you got the reaction, and then it just crumbled. That's a real tell. And there's opportunity there because there's confusion. Again, think about it, look at it through the lens of other participants. Confusion, there's stops being triggered, there's supply coming in. It's the perfect ducks in a row. And where you put your stop, you're going to put it above the news failure point. Now, admittedly, in here, you might have to be a little bit smarter than that because it's quite wide, but you get the idea. You know exactly where the thesis is negated. Now, in bull markets and bear markets, you get these often very different. So often in a bull market, you'll have bad news that just gets shrugged off and it just rips. And sometimes you have good news that just gets shrugged off and it drowns when you're in a kind of bearish environment. Not necessarily a bear market, but more of a kind of bearish overview. I remember many years ago, I was in this mining stock and everyone was waiting for this it wasn't mining stock, it was drilling stock. It was drilling stock, oil exploration drilling stock. Many years ago, and touched this type of stuff. Illiquid, but fine. In it, lovely unrealized P&L. Everyone was talking about how this was going to be great and they're going to find all these barrels of oil and this thing's going to rip up into the stratosphere. And it rallied up from like 3 to 9p or something. And everyone was happy about this. Everyone's waiting for this news to come out. And it kind of squeezed right up to like 12p the day before the news. Everyone's like, this news is going to come out. This thing's going to fly. 30p, 50p by Christmas. Everyone's there thinking they're going to get rich off this thing. All of a sudden, news came out. Bang! They'd found loads of oil. It was the best news in the world. They got all these barrels of oil to explore. It was worth X. Wow. Everyone's like, man, this thing is going to fly. And it ticked up a couple of pence. It stayed there. And everyone's like, you know, come on, do something. Like, come on, look at the news. I want to see the news. And then it started to tick lower a bit. And then he got people saying, hasn't digested it yet. Buy more. And so some of these guys bought more. And then it ticked up again on that buying. And then it started to tick lower and lower and lower and lower. And all of a sudden everyone went quiet because everyone was thinking the same thing that I was, is why the hell is this not going up? This is the best news. Is what news everyone's waiting for. Why is it not going up? Well, simple, because everyone's already long. Everyone was already long. This wasn't really an institutional stock that's going to attract extra money. And now everyone's long and hurting and wondering what's going on. All that lovely, juicy, unrealized P&L they've got sitting there, they see disappearing right in front of their eyes. And I appreciate it's exaggerated, a different market, not something you trade, but the concept's the same. Is that the news came out, it should be super bullish. It wasn't. Head scratch. Why not? Give it a moment. Give it a moment. And then everyone's like, get out. Doof, doof, doof. They're not. Everyone goes quiet on the chat, but everyone knew everyone was dumping because it's like, well, no, it's not going up anymore. And it was that one-way street of like realization. And that was it. That was the top for that for I don't know, years. Because it creates so much froth. I know it's slightly different. I appreciate that it's not quite the same. But it's people, it's people thinking things. And so news failures are often very, very good times to initiate trades because everyone's thinking the same thing. And when it doesn't happen, you get a real good insight. And actually, if you think about that kind of scenario I gave you there, in maybe thicker markets like NASDAQ, like S&P, whatever it is, a lot of participants who are already holding inventory may wait to see the response to news. They're like, okay, well, let's just see another earnings cycle. Let's just see an NFP cycle or FOMC move. Okay. And then when they see that, they go, okay, now I'm going to dump. I don't want to buy it. No one else is buying. So you kind of get this participation of crowd swinging around in one direction. So how to trade failures? Anticipate. We're not guessing. We want to anticipate. We're prepared. Like I say, they're not something that's going to happen all the time. When they do happen, I think they've got a decent edge. You want to put your stop near that clear failure of the failure point. if that makes sense. So if it's a failed chart pattern, where would it kind of come back into play? That's really your stop. Now, appreciate you might want to adjust it and be a little bit smarter, a little bit more tighter and aggressive based on the time frame we're trading. But generally speaking, I think there is an asymmetrical risk reward, which is a really good attribute to have for a trade. And again, if you're targeting stuff, maybe intraday, whatever, you want to go, okay, where's the next level where there's going to be another decision? Because let's say in a bull market, a failure to break out won't necessarily mean that it won't continue and break out later on. So we're not overstaying our welcome here. We always have to understand the context of price and the regime we're in, but we know where's the next decision point. At some point, if it fails to break out, that might be a very, very aggressive selling and a massive overhang of supply coming in. But the broader macro theme will probably pick that up at some point. And so maybe you want to target, hey, where's the last pocket of liquidity? Where are stops on this based on that? Where's the VWAP? So you still want to be smart and still be, potentially cash flow in the trade. Depending on the regime, maybe it's a complete reversal. If it's the direction of the trend, great. You might want to hold a little bit longer. If it's a counter trend trade, you might want to say A to B, it's a failure, it's aggressive, again, a quick profit, I'm done. So psychology, breakout, they get the FOMO, panic exit, should have gone, I want to get in, this is flying, easy trade the breakout, reverses, oh no, it's going against me, dump. You're trading, shorting that dump, and you're trying to capture that urgency on the wrong side. People are in pain, people are trapped. Again, we're going to go into much more depth, the trap trader setups and real intricacies of timing that sort of thing in a couple of weeks' time. VWAP hold fails. Again, institutions should be holding this, should be popping off. Doesn't, fails. Everyone's looking at the same thing. Oh dear, what do we do now? Let's dump it. Shorts, attracting more supply into the market. Opening drive, talked about that one. People trap, people FOMOing in, reverses, catches them out. Not as strong as we thought. Oh dear, the real time frame, higher time frames coming in. The hardened trader is calm and waits. It doesn't happen. You're not expecting it, but you're ready if it does. Okay, so some drills that you could perhaps try, because I know that some of these concepts are like, you know what? Is this any good? Is it going to work? And you have to decide whether it's something to kind of peel into your layer into your playbook or not. But I will say that I think that if you are a newer trader, this is not, even though it does seem complicated, it's a good place to start. And it's a good place to go, hey, I want to differentiate myself from the pack. How can I do that? How do I have the obvious place for a stop? And how then looking for failures and being your North Star as a failure trader. If you're intermediate advanced, you probably do some of this stuff already. It might be time to double down on it. It might be time to say, hey, let me look through my performance. Let me look through my journal and my blotter and actually look at times when I'm trading a failure, maybe without even knowing it, they're actually my better days. Something to consider. Screenshot your failed set. When you see any failed setup, screenshot it, categorize it, make a playbook that works for you. VWAP might not be your thing. Opening drive might not be your thing. Maybe you're a support resistance trader. Maybe you're a flag trader. Whatever it might be, you look for failures of the stuff that you look for, and then see how that played out, and see if you can build a setup and playbook around that. Do your sim replay stuff. I'm a big advocate of that. Run through trading views, very, very good at that. And think about what journaling, what should have happened, and most importantly, which I didn't note down there, is the psychology of other participants. If you take anything from today, please just consider you're trading against other people's money. Not always a human clicking, sometimes an algo, but it's still other people's money. They own that. People got different attachments to money, still with the same objective to making more of that money. And so think about what they're thinking. What are the short-term traders thinking? What are the people who bought this before thinking? What are the people who are observing this, who don't have skin in the game and aren't trapped to thinking? Were they bullish and now they're like, oh my God, I'm bearish? Does that create a sense of urgency that could be shorted into? Just that little bit of clarity. And as you start to progress as a trader, that should be the default, I think, as opposed to looking at prices and going, oh, it's a nice, pretty pattern. So some takeaways for you as we wrap this up, guys. Failed patterns, I think, are edge. They work, or they can work, should I say, because I believe they expose who's really in control. There's that point in time where everyone goes, that's interesting. We've really got an insight to who's in control. Most of the time, you kind of know. You've got a rough idea. We're in an uptrend, the bars are in control. Downtrend, chillers in control. Chopping around, no one's really in control. at that point in time, you see the control shift. Buyers were in control, and now they're not anymore, because that was a point where they should have held the ground, but they didn't. So that means something. That's meaningful. And trading is all about spotting the meaningful points on the chart or in price that we can exploit and take advantage of. That's our job. We're not here to macro trade. We're not here to take positions over multiple months and years. We're here to try to spot these short-term patterns that we believe are repeatable. And one of the things is to be able to get good at spotting when their patterns shift, when the supply demand shifts, when the control shifts, because that shift can be the start of something bigger, can be the catalyst for momentum, and as I say, you can frame the risk a little bit cleaner there, and often start bigger moves. I said that failure is fuel. Okay, any questions? I'll take them, ladies and gents. This is good stuff. I like this one. Thank you, Pepperstone, of course, for partnering with me and letting me talk about this kind of stuff. If you're trading with them, you're enjoying this webinar. If you're not, you come from elsewhere, then yeah, have a little look and see if those guys offer something that's suitable for you. Let me leave it back on this. Well, I can see a question pop in there. Let me leave it back on this. Where is it? Takeaways. All right, you failed traders. Let me rephrase that. You failed chart pattern traders. You right. Gary Portugal, thanks. Great session, Mark. Appreciate you, Gary. As always, pal. Good to see you back here. Good to see everyone back. Alison says, thanks, Mark. Gem of a webinar. Appreciate it. Appreciate you too, Alison. Hope you've enjoyed it. Robin says, Mark, as always, thanks so much for another great webinar. Oh, there's more to this one. There's more to this one. Okay. When trading failed patterns, recognition is one thing, but timing the actual trigger is where I personally struggle. This is a great question. I can feel it brewing into a great question. You said the key is to react, not anticipate. But as a technical trader running structured systems with defined signals, it's not practical for me to just flip and reverse as soon as my stop gets hit. How do you personally define or time the actual trigger that confirms the failure? So it's not just a random second entry, but a valid system level setup. Love that question, sir. Let's go to a chart. So you want to time the entry at a point where there is, you believe that's the actual tick where the failure is true. And so, for example, opening drive reverse. The failure is when you've had over. Let's talk about it in terms of if you were building a system from this, and this is not my wheelhouse, but I'll try. You might have a variable that says if first 15-minute range is greater than X, X being the average 15-minute range over the last 30 days, right? There's your parameter, tick. If price then trades back under the opening print, go short. So you've got your filter, which is I've got my long, people long, the first 15 minutes is a decent range. And then you've got your trigger, which is if we breach that open, which we really shouldn't, that's my entry point. And then you can adjust the stop to suit. Now, this is a little bit of a funny one because theory, the stop should probably be above the high. Depending on the range of that, as might be too much, depending on the time frame, etc. So you might have to be smarter and say, well, if this is a true kind of breakout, I probably can punch it above the prior bar high or something like that. So now you've got a systematic approach of, okay, here's my prerequisite. I want the pattern to set up, the opening drive, the pull back, head and shoulders, the breakout, whatever it is. Define that in your own words, and then you have to come up and say, well, where would that fail? In this example, it will be as it trades back through the opening print. So if price is equals open or less than open, short, stop here. That's how I would look at it and how I would perhaps frame it. Now, if you're already long, then it's up to you. You might be like, okay, well, I don't want to because I might get caught in this. Of course, market might chop around and slam you both ways. So there's a psychological impact of doing that, which I appreciate is not always easy to do. But if this wasn't, and in fact, I would probably say, I'm not making any recommendations or suggestions here, but if it was me, I would think of this as a separate playbook to build. So what are you not doing at the moment, and what makes it more exciting for failures? So what's my failure playbook? So it's not the opposite of your kind of go with it playbook, for want of a better word, but it's a brand new playbook that you do that you say, if that fails, then I'm interested in taking it. So hopefully that helps. Dennis says, cheers, Mark. Always insightful. Dennis in Bath. Dennis, thank you, pal. Robin says, I watched Tom Hugard train the DAX today. Took 3 longs, all got stopped, and then he flipped short aggressively and made everything back in minutes. It looked like pure instinct, but I suspect it was a blend of experience and a system. When it comes to timing failed setups, do you believe this kind of flip should be rule-based and systematic, or is there an element of traders' feel that only comes with screen time? I think a bit of both, right? I think, as I said, you can probably come up with rules that indicate when people are trapped, but often, in that case of Tom, if he was pressing the long, it didn't work, and what he saw was probably a lot of people like him stuck in that and smashed the short. He didn't have to trade that just because he was trading the long. He happened to have been trading the long because he was on that instrument, but the better trade was probably the short because the longs were being pressed and were constantly getting slammed out. So I think a bit of both. I think you can definitely build some rule-based some rules for this and build a rule-based system. But ultimately, me just coming up with just sharing these with you now are obviously based on me observing this stuff, trading this stuff over the years, and being able to sort of pick some examples and say, hey, this is a failure. Your job is to kind of go away and think, what would be a failure in my market, in my time frame, the way that I like to look at it. That might not be an opening drive. It might be, let's say if you were a slightly higher time frame trader, it might be that it closes at highs on a big kind of bull bar day, and then the next day reverses and takes out that low. You might be like, hey, that's really good. I like that because that's a failure, and I've seen a precursor of price action that passes a filter check, and then my trigger is we trade below the low print or something. So I really do think you can do a bit of both with that. I hope that's helped in some way. Thanks, Mark. I did laugh at your seesaw impression. Scottish John got a milking job for you with that technique. Oh, did it really look great like that? Yeah. Cheers, Barry. Thanks. I can think back now exactly what I was doing. I'm wondering if there are signs it may be a large failure. If there is, I was wondering if there were any signs it may be a large failure or reversal rather than just a pullback. I think if you have the more volume and the more participants that are involved in it, that's probably a bigger failure. Now, I'd never be overstay my welcome going against the trend, right? If we had we're in a bull market, admittedly now we're a bit stagnant, but we're still a bull market, I'd be very mindful about overstaying my welcome on the short side, because just the overall fundamentals are always going to kind of catch the market unless something changes massively, which at some point it will, but who knows when. So I would never be too aggressive and overstay my welcome against the higher time frame trend. But it depends on the level of the gap, the level of the drive. I'm not going to be taking every 15-minute breakout that fakes and stuff that you're just going to get caught in nonsense. Again, Barry, the key to this is to really look at it through the lens of other participants, right? If you can see that other participants have been watching this and expect X to happen and Y happens, and the more people see that and the more obvious it is, the more likely there's going to be people trapped, the more likely that the little look under the bonnet is indicative of true supply demand shift. So this rally of the open, everyone sees that. There's no ambiguity there. Everyone sees an 0.84% rally, which is a lot in the first 15 minutes. That gets given back and it rolls over more. That's more likely to bring in a higher time frame participants, a lot more volume into work. If that was just a little tiny breakout on a 5-minute chart, no one really cares about that. It's not something that's going to be that valid. So the more participants, the better. And I'm glad you enjoyed my milking seesaw. Felix says, what's your preferred? Let me bring you guys here. What's your preferred way to assess consolidation and ranges? What time frames? Any thoughts of acceleration of price? What's your preferred way to assess consolidation and ranges? What time frames? Felix, the longer the consolidation, the more likely the breakout's going to be more aggressive, right? Consolidation or lower time frame is almost meaningless, right? It's just a pause for 5 minutes is nothing. A pause for 5 days in a bull market, that's there's a lot of people who are the volatility is contracted. People are going to have to put some money to work. And so depending on what time frame you trade, I'd be more inclined to put more weight on a higher time frame consolidation. And as far as assessing it, I just eyeballing it, mate. I'm just like, there's consolidation. We might kind of dip below a little bit, but ultimately, does it look like a range? I'm not going to overthink it. Yes, if we break out aggressively in one direction, I might buy that breakout. I might be the one getting caught initially. If it fakes and goes in the other direction, then I might be like, oh, that's even better trade, just like mentioned before. An acceleration, you just want to see like price just, quick in one direction, holding, that type of stuff. Eric says, when price comes with momentum and breaks out aggressively, then you plan for a retest but fails. Would you immediately plan for a reversal because in some instances there will be a double fake out? I think that this is the kind of North Star I believe you have to have in your mind. You have to set your stall on. Now I know there's an example there of perhaps Tom flipping in one direction or another, but I think that's rare to be able to do that aggressively and with conviction. Tom's a very unique trader with his own unique style, fine. But I think for most traders, it's setting your stall on one direction at a time. And so if you're planning for the fake out, then you take that fake out when it happens, you let the break go. If it rallies, you leave it, right? If it comes back, you're like, okay, has it really faked me out yet? Is it really a failure? Not yet. And then when you see it, then you hit it with everything and you take the trade from there. I think the danger comes, and I was mindful of this when I got on this topic, is if you're flip-flopping between taking the breakout, taking the pullback from the breakout, taking the fake out, you're trying to do too many things at once. I won't bore you with another extract. There's a little extract in here that says exactly that. In fact, I'll do it in an email. I've done it in an email, should I say, where even Wyckoff was saying if you're trying to do long and short at the same time, it can be. Now, listen, some people can do it absolutely fine, but there's enough opportunity to be able to just have your stall set. If you think I like to be prepared for this failure, then wait for the failure. If it doesn't fail, you don't take the trade. If you say I want to trade the breakout, I'm not bothered about the failure, then the failure can be the place of putting the stop. I just made some sense. Okay, David says, can you look at Monday morning 9/9/25 yen failure of the Asian gap higher after Friday close as an example of a failure? Let me have a little quick look on my chart here. What are we looking at, man? Dollar yen. I think I should share it, but I can't quite share it. And we're almost at the end. So let me see. So 9/9. 9/9 Monday morning. That's today for me. So I'm going to think you're maybe somewhere different. But okay, failure of the Asian gap session higher after Friday's close. Okay, yeah, maybe. It's not like everyone's looking at it so much, right? Because even on Friday, yeah, the Asian session was slightly different, but even there's some trade on Thursday, late Thursday. It's not a big level. I mean, here's something for you. I know we'll look at different chart. Everyone's looking, but if people are looking at your dollar yen, like if you traded up above 149.20, yeah, that's a multi-day high. That's an important level. It hasn't been breached since kind of beginning of August. If you traded above that and failed, that'd be more interesting. I'm not saying what you see isn't valid, but not everyone cares about the Asian range. Not everyone cares so much for the failure of the Asian session gap. It's not as obvious, and yeah, it's fine. But the less obvious, the less participants are trapped. So for me, it would be like a true failure would be, hey, let's sniff around. We almost had it to a certain degree. Today on the yen, and we dip below 146.40. I'm not a big currency guy, so take everything I say with a pinch of salt with regards to FX stuff. But that not quite, because we didn't break through the ultimate low that we've had at 146.22. But there may be some people trapped. Kind of looked around, went below a multi-day low, didn't like what it saw, popped back up. That's almost in the failure territory. It's more like kind of stop hunting. I know there's the gray area there, and it's not necessarily black and white, but for me it's like, okay, I want a bunch of people thinking one thing, I want a bunch of people trading that. I want it to be so clear and so obvious, and to all of a sudden be so ambiguous and so painful that I want to capitalize on that. That's kind of the way that I like to look at stuff. Last questions, Anthony. Hi, really great webinar. Thank you, Anthony. Appreciate the feedback, pal. Do you have any advice on how volume can be helpful in supporting the failure trade? Good question. Thank you for bringing it up. Yes, volume. You want to see volume really starting to pick up as the trade starts to fail as the trade starts to, if you look at the IWM chart I've got up here, which is great because actually it is a exchange-based product, so you can actually see it's an ETF. Look at the way the volume picks up as it starts to roll. I don't know if you can see my cursor. Sorry, I don't think you can. But as it rolls back through the opening print, which is the green line, the white line on that range, look at the volume. It spikes up and it rises, it's high, high, high. It's picking up, picking up, picking up. And then only when we kind of got the ignition reversal bar did it, and it kind of filtered out and it really drifted off as it was drifting back up. So yeah, good question. Volume picking up, because again, participants, get me out of here. I don't want to be in this trade. Dump, dump, dump. They're no longer price sensitive, they're time sensitive. Get me out at any costs. That generally shows up in bigger volume, larger range candles, bigger volume. That tends to confirm the failure. And then when it starts to kind of peter off a little bit, you have a decision to make. You have a decision to make, Anthony. You say to yourself, do I want to hold the trade because I think there's more meat in it or more juice in it? And you're a vegan or meat eater, and then you go, okay, I'm going to either take the profit, cash flow the trade, or I'm going to hold it and maybe structure trade and use the failure as a catalyst for a bigger play that maybe you had in mind. Okay, I hope that's been of some value, ladies and gentlemen. Thank you so much for your attention today. Keep the risk managed as always. A few goodies coming up in terms of market news. We should be back again same time next week, drawing lines on charts, what's good, what's bad, how to structure them, all that other good stuff. I'll help you as much as I can. Any questions, you can reply to my daily email if you haven't got it, tradersmastermind.com. I reply to every single message I get, even if it takes me all morning. So if you have a question, if I can help, absolutely will. If I can't, I will probably direct you somewhere or someone who can. Good luck, ladies and gents. Keep the risk managed. Bye-bye.